Dave Lee is a well-known YouTuber who invests as a Tesla bull. Known for being a Tesla devotee, he wrote in a post that he was able to raise the initial value of his Tesla shares by about 100 times. He stated that when he first purchased Tesla stock, he anticipated that its market valuation would increase tenfold. From $3 to $40 billion, and now says that history might repeat itself. Why does he think this is true? What is the census of analysts? To find out, keep watching. He claims that the same misconceptions that existed over the original iPhone also apply to Tesla. He thinks Tesla is only getting started and is embracing complexity through innovation. The investor expressed astonishment at how holding common stock allowed the Tesla stock to increase 100 times in less than 8 years. He thinks that in another 8 years, the stock would rise even further, possibly by a factor of 100. If you've been watching this channel often, you're surely aware that Tesla released some very encouraging numbers for the most recent quarter. Despite the current macroeconomic environment, Tesla had an amazing quarter, exceeding experts' projections by $3, 32 cents billion on Ravina of $18, 7 cents billion, an 81 increase over the previous year. Musk addressed Tesla instead of Twitter, as many had anticipated that he would discuss the company's future plans. Here are a few of the most important lessons learned from Tesla's earnings call. All expectations, especially Wall Street's, were completely exceeded by Tesla. Barron's reports that Tesla easily outperformed Wall Street's estimates of $18 billion in revenue and $2.20 to $2.30 per share. Moreover, the operating profit of the corporation exceeded analysts' expectations by almost $1 billion. Consequently, Tesla's stock rose 5 and after hours, trading to $10.17 a share from the close of approximately $976. Lee says that too many people base their judgment of how their company did against analyst expectations for EPS, revenue, margin, and other measures on their comprehension of the earnings report. He went on to remark that the issue with this approach is that most common stock shares are unknown to the experts. There are analysts who work for companies where they don't even own stock. So whether the company's profits surprise or disappoint them doesn't matter. Forecasts from analysts and investors for young, high-growth companies are sometimes at odds, but this is especially true for Tesla, which has proven to exceed forecasts for some time now. Consider the first quarter earnings of Tesla. Though they were in line with investor expectations, the numbers beat analyst estimates. Many financial professionals were taken aback since they had been so preoccupied with the analysts' predictions and how much Tesla had exceeded them. However, they were less concerned with whether or not Tesla had surpassed investor expectations. However, Lee claims that since Tesla only met or very slightly exceeded market expectations, it lacked the initial momentum required to keep going and reach new all-time highs. After the earnings call and disclosure, shares increased by just sick, as devoted investors had already elevated their expectations for Tesla and its leadership, particularly in light of the company's strong delivery metrics. This is not shocking at all. According to Lee, a stock's revenue production determines its. One of the reasons for Tesla's poor first quarter performance and the stock's failure to hit an all-time high was restrictions. Due to considerable COVID-19 containment measures and an increase in cases in the nation, Tesla's Giga Shanghai facility was forced to close on March 28. The idling started around the end of the first quarter, according to Credit Suisse. The company's performance in the second quarter was anticipated to be significantly impacted, since the Shanghai factory is the largest in terms of output and may see a decline of approximately 90,000 vehicles in the upcoming weeks. We are nevertheless upbeat because Tesla's management appears to be in control. Despite China's zero COVID crackdown forcing the closure of Tesla's Shanghai Gigafactory, which produced more than half of the firm's vehicles last year for several weeks, the company stated that current quarter deliveries should remain flat when compared to the first 3 months of the year. It is anticipated that 1.47 million units will be provided during the course of the year. According to Lee, Tesla needs to demonstrate revenue growth in order to sustain its optimistic quarterly climb. The stock price should rise as a result of them delivering more cars than investors predict and exceeding revenue projections. It is realistic to expect an increase in the stock price given Tesla's stated intention to raise output by 50 by the upcoming year. Not everyone shares Dave Lee's enthusiasm for Tesla's expansion. In its Quinn 2022 investor letter, Warm Capital had a lot to say about Tesla by 2030. By 2030, they predict that Tesla shares would yield a return of 10 times, if not more. A main holding of the company, Tesla, has been more upbeat recently. The company claims that they raised their Tesla shares in Q1 as a sign of their heightened confidence. They believe that over time, Tesla will do better than the SP 500, according to them. Tesla still has a minimum of 10 years of development left. It's only now that it's approaching the tipping point where it may develop quickly and rapidly, much like Amazon did after the financial crisis and the NASDAQ bubble burst. Investor in Tesla, Gary Black, also offered some fascinating future predictions for the electric car company. According to him, Tesla's market value ought to be $4 trillion. Currently, it's $100 per share. Earnings translate into a $1.09 trillion value. He sets a price target of $3,000 based on a 30 price to earnings ratio with 1.4 billion shares in circulation. Tesla would have a market valuation of around $4 trillion. Black predicts that by 2030, 60 of cars worldwide will be electrified. 20% of the market for electric vehicles will belong to Tesla. Additionally, Black projects that by the end of the decade, Tesla will be producing about 10 million cars annually, with 85 million light vehicles sold globally. But before things get better, they can get worse. Analysts claim that Tesla's stock price fluctuated a lot around the key $1,000 mark, falling from a high of $1,152 to a low of $902 in April. From what source was the turbulence coming? High-tech stocks are losing favor with investors, as Apple and Microsoft have shown. However, there is concern over China's ongoing COVID-related outages. Given the situation in Shanghai, it is difficult to see how Tesla will reach its delivery targets. Dan Ives. Tesla Bull from Wedbush brought out a few issues in a note to clients on Tuesday. According to Ives, the main worry for tomorrow is how serious China's manufacturing problems are and how this would affect deliveries in the second quarter and the remainder of the year. One analyst believes that Musk is in a difficult position because there are a lot of unknowns around China's production in the second quarter, which will definitely affect estimates for the remainder of the year. Consequently, throughout the past month, there has been a clear overhang on the stock. Star stock picker Kathy Wood, a long-standing supporter of Tesla, doesn't seem to be fazed by these worries. Her company, Ark Invest, declared that they think Tesla stock may be valued at $4,600 by 2026. By 2025, the business had originally projected a $3,000 share price. In an earlier analysis, the bull scenario predicted a price of $5,800 by 2026, while the bear case predicted a price of $2,900, which is still more than 3 times the $1,005 current price. Assuming nothing else, Ark projects that Tesla's value will almost quadruple by 2026. The investment firm stated in a note to investors that we believe our Tesla model is methodologically conservative, even though it is calibrated to our 2026 estimate. In 2026, we predict that Tesla's shares would behave more like those of an established company than a fast-growing one. An important factor, in the opinion of Ark analyst Tasha Keeney, is the expectation that Tesla will be more capital efficient. Consequently, from $84,000 in 2017 to $7,700 this year, Tesla's capital investment per extra unit of capacity has decreased. When it comes to his investment, Dave Lee has repeatedly expressed that he is in it for the long run. He is adamant that Tesla will see phenomenal growth by 2030, and it appears that his belief is well-founded. Tesla led the U.S. electric vehicle market in the first quarter per Kelley Blue Book figures. 75% of the electric vehicle sales between January and March 2022 were made up of Tesla vehicles. During the first quarter of 2022, 68 of all electric car sales in the U.S. were made up of Tesla's Model 3 and Model I models. Those numbers indicated that 7 of Tesla's vehicle sales were made up of Model S and Model X models. As the EV market gets more competitive in the third quarter, Tesla will need to grow. With the support of its new headquarters in Texas and gigafactories in Berlin and Shanghai, Elon Musk's business seems prepared to challenge for the top spot in 2022. By 2023, Tesla wants to have up to 1.5 million cars produced, and it also wants to start building its other vehicles, such the Roadster, Semi, and Cybertruck. By 2030, what do you estimate the value of Tesla shares will be? Please leave a comment below.